Good morning, Mayuresh. Thanks so much for joining me. I want to start with HDFC Life, and it's a stock I think that a lot of analysts like. Again, with earnings, I'm not sure if we can compare the year ago period, but having said that, I think a few numbers stand out for HDFC Life. Gross premiums, I think, particularly came in at 35% growth at 10,183. Net profit grew 6%. Value of new business margins came in at about 25% for the first half. I think to be expected to a certain extent. Um, but without going into too much of the numbers, what stood out for you, and what are you looking for with regard to HDFC Life?
Morning, Alex. Thanks for having me on your show. So you're absolutely right. I think with the expectation in terms of earnings delivery for insurance companies and specifically life insurance companies, I think the landscape probably looks far better over the next few quarters. Yes, I think a direct comparison on a year-on-year basis, or even because of the lockdown of the previous 2 quarters, I think is a little unfair for all these companies. But again, I think in terms of the earnings delivery, the market share, in my opinion, has increased to 17.5%. So that's a very, very strong positive. The new business margins have held up pretty strongly beyond the 25% mark, which shows that the product mix is absolutely well balanced at this point of time between the protection products, the participating, the non-participating, and a very low share of ULIPs in its overall product profile, which abets the kind of value of new business margins which consistently stay over the 24-25% mark. The third element, as you rightly pointed out, has been the renewal premium growth. So 22% growth in a quarter where I think the expectation is not large enough. I think the biggest growth probably comes through in the last quarter, Q4, when a lot of tax saving instruments are directed towards insurance schemes. But I think it's been a very, very steady performance. Solvency ratio at 203%. The expectations in terms of the persistencies on the 13th and the 61st month has improved, if I would say, on a year-on-year basis. And that itself, again, abets to the positiveness that the stock might exhibit. So yeah, I think the earnings delivery has been good. All these parameters probably standing out. As per our own O'Neill methodology and Cancel methodology, I think the price action is somewhere that we'd ideally like now the stock to see some amount of traction based on numbers. The commentary is also hinting out that the next few quarters and years should be really good. So I think awaiting price action to probably get into the stock, but yes, it's a good story to be structurally played.
Interesting. I'm glad to hear that. Not very often that I get a very clear signal from you in terms of a stock that you like. But having said that, the second stock is Britannia, Mayuresh. And, again, I look at the numbers and I think that the margins stood out, came in, I think, a percentage point higher than consensus estimates at 19.8%. The other numbers, of course, as a consequence, I think net profit came in at 23% higher, 495 or thereabouts crore, but that is in line with estimates. What did you think of the numbers, and would you play Britannia as part of the consumption story?
No, so I think the expectation, Alex, were largely pointing out to how they delivered in Q1. So the kind of volume growth that we saw in Q1 because of lockdown, the increased consumption of biscuits, both premium and the standardized versions, did play a huge part in terms of how the numbers stacked up for Britannia or for the biscuit industry as a whole. Now, for these numbers, I think the expectations were again on elevated levels as far as the overall consolidated numbers are concerned. And yes, I think there was an amiss in terms of the expectations of volume growth and the delivery that they probably did. The margins stayed a bit better, but that was always expected because of some amount of consolidation that we've seen in input costs. But again, I think the caveat here is that input costs have started inching higher. So whether you're talking about milk prices, milk powder prices, flour prices, and that again might have some impact in terms of the margins going ahead. The gross margins, Alex, surprisingly have always remained between that 40 to 45% mark. And the valuations have always been steep for Britannia. Again, the management commentary is still hinting out a very, very slow and gradual recovery, which will probably not abet a scenario where I think the earnings have been a little bit lower than what the street was expecting, along with a slow and a steady recovery and a gradual recovery in terms of the earnings profile. Yes, they've improved their market share in a few key states like Madhya Pradesh, Rajasthan with their direct reach. But what probably happens in terms of valuations and earnings delivery, I think that will be something that will play out on the stock from a near to medium term perspective. So we'll wait and watch for this one. Our own sense is that let's see how the other companies deliver numbers. But strictly in terms of Britannia numbers, a little bit disappointing on what the market was probably believing. Valuations a tad bit on the higher side, and again, the stock has largely been consolidating over the last few months, which means that we will probably need to have 1/4 more of solid earnings delivery and management commentary hinting to strong earnings revival, which probably might take the stock in higher trajectory as far as the justification for valuations are concerned.
Okay, wait and watch for Britannia, I think, is the verdict. Let's talk about the last stock, which is ACC. And I'm interested to get your view, not just on the stock, but also on the sector, Mayuresh, based on the results that came in for ACC. It's a seasonally weak quarter for this, at least half of that because of the monsoons, but still come in reasonably better than expected, right? You see margins that have come in better than consensus estimates, and net profit is a significant beat. What do you take away from these numbers, not just for the counter, but for the sector? And what would you pick in the cement sector as a play going forward?
So largely, Alex, the first 2 quarters are always expected to be a little bit on the softer side. Monsoons, infrastructure activities goes for the back burner. But as the monsoons are now over, Q4 starts as the resumption of industrial and construction activity in full swing. So I think those are positives and a structural aspect for the sector as a whole. The second element for the sector itself is that the demand-supply dynamics. The kind of capacity additions that have been happening for the sector over the last few quarters have not been that significant, which probably means that as demand comes back very, very strongly, as the central government spending will happen on a lot of these construction stroke infra-related projects, the cement demand will come up very, very strongly. The third element is that there have been some instances on media reports suggesting that you've probably seen some price hikes being taken for selective regions or for the sector as a whole. And input costs have probably remained very, very benign. And the expectation is that input costs should probably remain in this range, whether it's coking coal, iron ore costs, so on and so forth. Therefore, I think the EBITDA per reported ton should gradually start showing signs of improvement. ACC, I think, on most parameters have delivered an excellent set of numbers. So the realization degrowth per ton, much lower than what the street was expecting. The margin expansion, because of all these factors at play, at 19% were outstanding in my opinion. And volumes at 6.49 million tons in line with estimates. So again, I think structurally, I think cement as a structure probably looks good. It is very, very well placed at this point of time as far as the infrastructure activities are concerned. And even from a valuation perspective, if you look at ACC's valuation stacks, $95 EV per ton, which probably puts it in a very, very fine pedal. So anybody holding on, clearly hold on. Our proper pick within the space remains UltraTech Cement, largest player, the synergies with all its acquisitions working in its favor at this point of time. Utilization levels inching up slowly to that 70% mark. The debt on the balance sheet, not too much. I think they're deleveraging quite significantly. And expectations of all these factors should start showing out in terms of cash flows actually improving. So as per our owning methodology and can slip, UltraTech, the leader in the cement space, probably looks attractive. But the entire sector, as I said, looks finely poised over the next few quarters.
All right. On that note, thanks so much, Mayuresh, for joining me this morning. Hope you have a great day. Thank you, dear viewers, for tuning in as well. I hope that this conversation was helpful to you. Do stay tuned. There's a lot more coming up in just a short while on Bloomberg Quint.